Welcome back, champions. Another mind-boggling stock news. Investing in stocks is a way to make your money grow over time. By regularly putting money aside to invest, you can see its value multiply over the long term. That's why it's important to begin as soon as you have the money to do so. The longer your time horizon, the better. This video takes you through how much you need, what stocks to choose, and the other basics of investing in stocks you need to get started, all in 10 easy steps. Let's begin. Step 1. Set clear investment goals. Begin by reflecting on what you want to achieve financially. You might have short-term goals like saving for a home or a vacation, or have long-term objectives like securing a comfortable retirement or funding a child's education. Your objectives will depend on your life stage and ambitions. Younger investors tend to focus more on growth and long-term wealth accumulation, while those closer to retirement typically prefer income generation and capital preservation. The more precise you can be about your goals, the easier it will be to sort out the best means to get you there. Here are some tips. Number 1. Be precise about your objectives. Instead of general goals like save for retirement or I don't want to have to worry about money one day, set specific objectives like accumulate $500,000 in my retirement fund by age 60. Number 2. Set your investment horizon. Determine how long you have to achieve each goal you set. You will have longer and shorter timelines for different purposes. In general, the longer you can give yourself, the less risk you'll need to take on, and the more viable your objectives will be. Number 3. Evaluate your finances. Be realistic about how much you can allocate toward your investment goals. This includes looking at your savings, regular income, and any other financial resources you can put to work as you begin. Number 4. Rank your goals. Most of us have several goals at once, like saving a down payment for a house, paying for a wedding next year, or preparing for retirement. Prioritize these and balance them according to their importance and urgency. Number 5. Review and adapt to changes in your life. The phrase financial planning is best taken as a verb, not a noun, since goals aren't set in stone, and planning your finances is an ongoing project. Life changes, and so will your financial objectives. Regularly review and adjust your goals accordingly. Step 2. Determine how much you can afford to invest. Determining how much you can afford to put in stocks involves carefully and honestly assessing your financial situation. Don't worry if your funds are less than you would wish. Just like you shouldn't berate yourself for not being ready for a race on your first day of training. So too, you're just at the beginning of your investment journey. This is a marathon, not a sprint, and you've got a long way to go. Here are some tips for giving yourself an honest appraisal of how much you can use. Number 1. Start with your income. In particular, you'll want to see if your employer offers ways for you to invest while gaining tax benefits or with matching funds that will amplify your own contributions. Number 2. You should have a solid financial foundation before investing, though solid does not mean perfect. Settle on how much you need for emergencies, typically covering major expenses. Number 3. Financial advisors also generally suggest making sure you've paid down your debts, especially credit cards and anything else with high interest rates. Any returns you expect from trading stocks are unlikely to make back the cost of the high interest rates accruing each month on your credit card statements. If you still owe on your student loans, look at how much interest you pay. Balance that against the returns you expect by investing in stocks, and choose whether it's better to pay your loans down or invest. Based on your financial assessment thus far, decide how much money you can comfortably put into stocks. This shouldn't dip into any funds you need for expenses now or down the road. Your budget should determine if you are starting with a large lump sum or investing smaller amounts at set times each month or year. Investing in stocks carries risk, and it's important to only invest money you can afford to lose. Never put yourself in a financially vulnerable position for the sake of investing. This is what separates investing from some of the worst forms of gambling. Step 3. Appraise your tolerance for risk. Understanding your risk tolerance is a cornerstone of investing. Gauge your level of comfort with the inherent uncertainties of the stock market. Your risk tolerance will differ depending on your life stage, financial goals, and your financial cushion for potential losses. Determining your risk tolerance is crucial for crafting an investment strategy that matches your financial goals while keeping your peace of mind. It helps you decide which stocks are suitable for your portfolio and what to do when the market goes up or down. Do you prefer stability, or are you willing to accept higher risks and price swings if that means there's the potential for more returns? This self-assessment is key to setting a foundation for your investment journey. Step 4. Determine your investing style. Everyone has a different relationship with money. But investors also have investing styles that best suits them. Some prefer an active role, meticulously poring over the last cell on the spreadsheets for their portfolios, while others opt for a hands-off, set-it-and-forget-it approach, trusting their investments will grow over time if they just leave them alone. Some just might not have the time to be active traders following the ticker crawls and latest reports on investing platforms. It's important to recognize that your style might evolve. Here are general directions for understanding your investing style. Number 1. DIY investing. If you have a good grasp of how stocks work and are confident to head out with minimal guidance into the market, managing your stock trades is one option. You can set up an account with well-known and trusted online brokers to access a wide range of investment options, including stocks, bonds, exchange-traded funds, ETFs, index funds, and mutual funds. This approach gives you full control over your investments, even if certain choices might be stock funds and the like managed by professionals with a fiduciary responsibility to look after your funds. Number 2. Working with a financial advisor or broker. For those who prefer the more personal approach and want more, an experienced broker or financial advisor can be invaluable. They offer advice tailored to your life experiences and goals, help you decide among the more promising stock choices for you, monitor your portfolio, and collaborate with you when adjustments need to be made. Step 5. Choose an investment account. You've figured out your goals, the risk you can tolerate, and how active an investor you want to be. Now it's time to choose the type of account you'll be investing through. Each has its own set of features, benefits, and drawbacks. You can choose your retirement account, taxable brokerage accounts, or from your accounts for specialized goals such as dividend reinvestment plan accounts, education savings accounts, health savings account, or trust and custody accounts. Step 6. Learn the costs of investing. Besides reputation and fit with your investment strategy and goals, broker fees are the most important consideration when you're choosing a brokerage firm, which comes in the next step. Traditionally, brokerages have charged fees through trade commissions, account maintenance fees, and fees for additional services like research or financial advice. However, the landscape of brokerage fees has evolved significantly in recent years. Here's what you'll want to look for as you do your research. Number 1. Trading commissions. A broker might charge a commission every time you trade a stock, whether you buy or sell. Trading fees range from $2 per trade to $10. Some brokers charge no trade commissions at all, but they make up for it with other fees. Depending on how often you plan to trade, these fees can add up, affect your portfolio's return, and deplete the money you have available to invest. Number 2. Maintenance fees. Some brokerages charge monthly or annual fees to keep your account active. These might be waived, though, if your account balance is above a certain threshold. Number 3. Service fees. You might pay additional fees if you haven't used your account in a while. Brokers also may charge for services like broker-assisted trades, access to their premium research, and trading on margin by borrowing. Most of these fees and the services linked to them are optional. Number 4. Subscription-based models. As Generation Zers and Millennials take up a larger share of the investment space, financial advisors, planners, and brokers are taking on clients used to month-to-month or yearly fees for apps and app-based services. Instead of paying per transaction or for specific services, you pay a flat monthly or annual fee. Your subscription may include commission-free trades, access to research tools, and other premium support. Step 7. Pick your broker. Brokers are either full-service or discount. Full-service brokers offer a full range of traditional brokerage services, including financial advice for college planning, retirement planning, estate planning, and for other life events. This customized advising justifies the higher fees that they typically charge, normally a percentage of the value of your transactions, a percentage of your assets under management, and sometimes a yearly membership fee. Minimum account sizes can start at $25,000. Whereas discount brokers offer you tools to select your investments and place your orders. Some also offer a set-it-and-forget-it robo-advisory service. Most have educational materials on their sites and mobile apps. Some brokers have no or very low minimum deposit restrictions. However, they may have other requirements and fees. Be sure to check on both as you look for a brokerage that's best for your financial situation. Additionally, you also have robo-advisors. For an automated solution, Robo-advisors or automated investment platforms are cost-effective and pretty effortless when investing. An app or platform takes the information you provide about your financial goals, risk tolerance, income and savings, and so on, and its robo-advisor creates and helps manage your investment portfolio using its specialized algorithms. Aimed at retail investors, robo-advisors are low-cost, usually have little or no minimum balance requirements, and are programmed for strategies suited for new and intermediate investors. That said, they tend to offer fewer trading options and lack the personal approach to financial planning best suited for long-term investing. Step 8. How to fund your stock account. Now that you've chosen the type of account to open, you'll have to fund it. Here's what to do. Number 1. Choose a brokerage. First, select a brokerage firm, perhaps one of the major online firms, that aligns with your investment goals and preferences or is simply most convenient for you. Consider factors like fees, available investment options, and the platform's user-friendliness. Number 2. Pick your account type. Decide whether you're opening a cash account, which requires you to pay for investments in full, or a margin account, which allows for borrowing to purchase securities. Number 3. Open your account. Once you've chosen a brokerage and account type, you'll need to open your account. This involves providing your personal information, social security number, address, employment details, and the particulars of your financial situation. This shouldn't take you more than 15 minutes. Number 4. Link your bank accounts. The most common way to fund your stock account is by linking it to your bank account. This is usually done online through the brokerage's platform, where you'll enter your bank account number and routing number. Many brokerages allow you to link your account via small test transactions for verification. Number 5. Transfer or deposit your first funds. Once your bank account is linked, you can transfer funds to your brokerage account, typically through an electronic funds transfer, which can take a few days to process. Other options may include wire transfers for faster funding if you're raring to go, though these usually cost more. Some brokerages still accept physical checks. If you prefer this method, you can mail a check to the brokerage or bring it to a physical location. Number 6. Set up periodic transfers. If you plan to make stock buys a habit, consider setting up automatic transfers from your bank to your brokerage account. Number 7. Start investing. Once you've verified the funds are in your account, don't worry. The brokerage won't let you trade otherwise. It's time to start choosing among the stocks that best fit your investment goals. Step 9. Pick your stocks. Choosing the right stocks can be daunting even for experienced investors. Beginners should look for stocks that have stability, a strong track record, and the potential for steady growth. Don't start out of the gate with a risky stock, thinking you'll hit it big right away. Investing for the long term is mostly slow and steady, not fast and rash. Here are some stocks that are solid bets to begin. Number 1. Blue chips. These are shares of large, well-established, and financially sound companies with a history of reliable performance. Examples include companies listed in the Dow Jones Industrial Average or the S&P 500. They are typically industry leaders and offer stability during market fluctuations. Number 2. Dividend stocks. Companies that regularly pay dividends can be a good choice for beginners. Dividends give you a regular income, which can be reinvested to buy even more stock. See how to buy dividend stocks to get started. Number 3. Growth stocks. The greater the chances for outsized growth in a stock, the riskier investing in it will be. Beginners interested in growth stocks should look for industries with long-term potential, such as technology or healthcare. Number 4. Defensive stocks. These are in industries that tend to perform well even during economic downturns, such as utilities, healthcare, and consumer goods. They will give you a buffer against market volatility as you start. Number 5. ETFs. Traded like stocks, these track many indexes or sectors and are a low-cost way to gain exposure to a broad range of assets. You can trade shares in them throughout the day at market prices. These funds often track a specific market index, like the S&P 500, and offer instant diversification, reducing the risk associated with individual stocks. As you gain experience, you can look at funds for sectors that pique your interest, themes that meet your investment goals, or indexes that track environmental, social, and governance stocks to match your quest for returns with your values. It's prudent to begin with a conservative approach, focusing on stocks or funds that offer stability and a good track record. This will give you confidence and returns to work with as you advance in your investing knowledge. Step 10. Keep learning about investing in stocks. Investing in stocks is an ongoing learning experience. Even the most successful investors are learning new tips and strategies each passing day. As the stock market continually evolves, staying up to date and going back to step one and reviewing your goals, available funds for trading, investment style, and so on will be key. Read books on investment strategies, stock market fundamentals, and diversification techniques. Use stock stimulators and learn about diversification. Just as financial planning is a verb, learning about stock investing is continuous. The more informed you are, the better you'll be able to make wise investment decisions and adapt to market changes. With these 10 steps in mind, you can easily begin your stock investment journey today. Let us know in the comments if this information was useful for you.